All right. Yeah, so I'd like to thank the organizers a lot for putting my paper on the program. So this paper is going to be about just like the previous one, about the governance of platforms that issue tokens. Recently we've seen a lot of developments in digital money and DeFi that have offered kind of a new alternative to the traditional model of online platforms. So the traditional model is very simple. So, the platform offers a service, that permits users to transact, and governance decisions such as how much to invest in upgrading the platform or how much to charge for the service are made by shareholders. That is, cash flow claimants are the ones who participate in governance. I mean, these traditional platforms typically don't issue their own currencies. Users typically transact on the platform using assets that are supplied externally, like, dollars or euros. And, the traditional platforms, just to give an example, are like eBay, for instance, or Airbnb, right? So recently we've seen two innovations that we think are kind of important. So the first innovation, which isn't entirely new, is the sort of fast proliferation of platforms that have begun to issue their own currencies. So these currencies, which are usually called tokens, typically offer a claim on the platform's transaction services in one form or another. So for instance, the Binance exchange, issues a token that allows you to get a discount on trading fees, or, the Golem network issues a token that allows you to rent out computational services on the network. Now, many of these platforms that issue tokens, though, keep the traditional governance model. So shareholders, cash flow claimants, are still the ones making governance decisions, whereas token holders don't have the right to vote. Now, the second innovation really is new, and it's what DeFi proponents often call, sort of decentralized ownership, by which I mean, giving users a direct ownership stake in the platform. And, what do these platforms do? So instead of, having shares and tokens, they just issue one asset called a token that bundles claims on transaction services with an ownership share in the platform. So, the canonical example of this is like a proof of stake cryptocurrency blockchain. It issues a token that users can use in transactions with one another, or they can stake the token and earn some, become validators, earn some transaction fees, and then get to participate in governance decisions. So the question that we want to ask in this paper is whether these innovations, in some sense, lead to platform governance that's more economically efficient. So in particular, I might think, does token issuance allow the platform to finance investments that wouldn't have been possible otherwise? And does this decentralized form of ownership, sort of achieve the goal of mitigating the platform's rent extraction from users? Now, so how do we answer this question? Well, we're going to build a model of an economy with a platform and two types of agents. So our economy is going to have users who transact on the platform, and it's going to have investors who don't transact on the platform but hold cash flow claims. All right. So when we look at a traditional platform, these cash flow claims are going to be shares, and when we look at a token issuing platform, these are going to be tokens. All right. So now, just like in the paper that we just saw, the concern is going to be that these investors who don't enjoy transaction services are going to make decisions that benefit them, but at the user's expense. So we're going to look at several models of governance in this paper. Governance is going to determine the platform's policies along two dimensions. So first, it's going to determine how much the platform invests in upgrading its transaction technology. And you should think of these investments as determining kind of the total amount of surplus that's available to be split between users and investors. And then governance is also going to determine the transaction fees that the platform charges for its services. And this is going to determine how that surplus is split between the two constituencies. And there are going to be some frictions in this model. So first, the platform is going to have some market power. So it's going to be able to partially extract rents from users. And on top of that, fees are going to be distortionary in the sense that higher fees are going to lead to greater deadweight losses. All right. And in this model, we're going to study three settings. We're going to first study, just as a benchmark, a traditional platform that's governed by shareholders and doesn't issue any transaction assets. And then we're going to look at what we call a centralized token issuer, which keeps the shareholder model of governance, but issues a token that's transacted by users. And then finally, we're going to look at what we call a decentralized token issuer, which issues a token that's going to bundle transaction services, claims on cash flows, and voting rights. All right, so just to give you a preview of the results, I mean, in our benchmark case of a traditional platform, the results are going to be kind of obvious. So, we have a profit maximizing platform that's going to extract rents from users by charging fees that are higher than its marginal costs. And, the fees that are too high are going to reduce transaction volumes and therefore reduce investors' incentives to invest in the platform. So it's going to be underinvestment in equilibrium. So then when we introduce token issuance, we're going to show that the issuance of tokens can partially align investors' policy preferences with those of users, but that's only going to be true if investors are capable of committing to a sequence of policies ex ante. And the idea is that investors would like to commit to a sequence of policies that benefits users because this is going to increase users' willingness to pay for tokens. So then investors are going to be able to issue those tokens to users at a higher price. All right, and of course, this logic falls apart if there's no ability to commit to a sequence of policies, because then after issuing tokens to users, investors would just like to extract rents from them anyway. So they're going to charge fees that are too high, maximize profits, et cetera. So you could think of many mechanisms that could allow investors to, sort of partially commit to policies, such as, token retention or smart contracts, et cetera. But we're going to argue that this decentralized ownership structure, can also provide sort of a substitute for any missing commitment mechanism. So we're going to show that decentralized ownership will actually overcome this commitment problem. And the idea is that when there's just one token issued by the platform, both constituencies are going to have an interest in keeping the token's price high. And now the token's price is going to reflect both the present value of cash flows and the present value of transaction services. So I'll show you sort of the loose intuition behind why having a single token promotes efficient policies is that a policy that destroys surplus is going to either reduce the present value of cash flows or the present value of transaction services, and that's going to decrease the price of the token, which is actually contrary to the interests of both constituencies. And now in the interest of time, let me skip the related literature and go straight to the model. All right, so we have a continuous time economy with a platform that's going to produce transaction services. And as I mentioned, we have two types of agents: users indexed by I, who enjoy transaction services, and investors indexed by J, who don't. So all of our agents are going to be risk neutral over consumption of the economy's numeraire, which we call dollars, and they discount at a constant rate, R. All right, so the platform's productivity parameter, which we denote by AT, and its level of transaction fees, FT, are going to determine users' transaction utility and the platform's profits. All right, and the platform is going to be able to make investments to increase its productivity. All right, and the investment rate and the level of fees are going to be the two policies that are determined in governance decisions. And in all of the settings we consider, there are going to be two types of assets. All right, so there's going to be an asset that's used for transactions, which we call a transaction asset, and users are going to need to hold transaction assets in order to transact on the platform. And then there's going to be an asset that we call a cash flow asset that investors are going to hold to receive a claim on the platform's profits. All right. So here are the three settings. So in the traditional setting, the cash flow asset is going to be shares, of course, and the transaction asset is just going to be something that's supplied outside of the platform, like dollars. Then when we introduce token issuance, the cash flow asset is still going to be shares with voting power, and the transaction asset is going to be tokens issued by the platform without any voting power. And then finally, in the case of decentralized ownership, where the platform is just going to issue a token that serves both the role of a transaction asset and a cash flow asset, and everyone who has a token is going to be able to vote. Right. So let me get into the details of the platform. So as I mentioned, the platform's productivity parameter and its level of fees are going to determine users' transaction utility and its profits. So a user is going to be able to engage in at most one unit of transactions, XIT, at each instant. And if a user decides to transact on the platform at time t, they're going to have to incur a participation cost, phi I. All right, and these participation costs are going to be heterogeneous across users, and they're distributed according to the CDF G. All right, so then if a user decides to transact on the platform, the utility they get is U of A, which is just an increasing function of productivity, which is our transaction utility, minus F, the level of fees per transaction. All right. And the upshot of this assumption that these participation costs are heterogeneous across users is going to be that, as fees increase, more users are going to opt out of using the platform, and that's where deadweight losses are going to come from. Okay, and then the platform's profits are very simple. So if we denote the aggregate quantity of transactions by capital X, the platform's going to receive the fee F times the number of aggregate transactions minus the cost it incurs, which are just, it incurs a marginal cost C per transaction. All right, and now the platform is going to be able to invest resources IT to increase its productivity. And so productivity A is going to evolve, the derivative of A is going to evolve according to this equation. So derivative of A is just this function H of IT, where H is concave and satisfies usual conditions. The way governance is going to work is that at each time, there's going to be a vote that determines the investment rate and the fee. And I'll describe the voting later when we get into the specific examples of different types of platforms. Okay, so now let me talk about the asset markets in this model. So, there are going to be two types of assets. There are going to be transaction assets, which have a price denoted Q capital T and supply A capital T. And users are going to have to hold these to receive transaction services. So, just like in any model with money in the utility function, a user's quantity of transactions is going to equal their real balance of transaction assets. So, a user's transactions XI is going to equal the price of tokens, the price of transaction assets times the number of transaction assets, little a t, that they hold. All right, so at each instant, users are going to choose their transaction asset holdings to maximize their lifetime utility subject to a standard budget constraint. You can go solve their problem, and their first order condition says that user I is going to participate and transact 1 unit so long as their participation cost is below this threshold phi star. All right, and so what is this phi star? Well, the cutoff level of utility is equal to a user's transaction payoff, which is U of A, the utility they get, minus the fee F, minus their opportunity cost of holding tokens, which is their discount rate R, minus the rate of return on tokens. All right, so then the aggregate quantity of transactions capital X is just going to be G of phi star, since all users with participation costs lower than phi star are going to participate and transact 1 unit. All right, and now investors' problem is going to be very simple. So at each instant, an investor is going to choose how many cash flow assets to hold. All right, these cash flow assets are going to have price Q capital C and supply A capital C, and these assets allow them to receive a claim on profits. All right, so in particular, profits are going to be distributed pro rata to the holders of cash flow assets. And investors just choose their cash flow assets to maximize their lifetime utility. And you got a very simple asset pricing equation, which just says that the price of these assets has to be equal to the present value of dividends. Okay, so now before I get into each of the specific examples, let me briefly, give you just a primer on what's the first best level of participation on the platform in this economy. So here I'm plotting a graph with the user I's participation cost phi I on the x-axis. So this downward sloping line represents the net utility generated by user I transacting on the platform, which is their transaction utility U of A minus their participation cost. And this horizontal line is the net cost of servicing user I. All right, so let's suppose, for instance, the participation cutoff were here at phi star. Well, then, the total surplus would be captured by this trapezoid here, but there'd be some deadweight loss, right? Because, the user at this cutoff still gets a positive net, his transaction generates a positive net surplus, right? Because U of A minus phi minus C is positive. So the optimal level of participation is when, the net transaction utility U of A minus phi is equal to the cost C of processing a transaction. I'm going to call this first best level phi FB. All right, so now let me get into the example of a traditional platform quickly, just to show you how that works. So the setup is simple. So in this case, the two assets are shares issued by the platform, that bundle cash flow claims and governance rights. All right, so this is the cash flow asset, and then the transaction assets are just some asset that's in elastic supply and is supplied outside the platform. So the price of these assets is going to equal 1, and you can think of this as like dollars or stable coins or something. All right. So investors are going to hold shares, and they're going to make governance decisions sequentially to maximize the share price. So, they're all unanimous in their preferences. They just want whatever sequence of policies maximizes share prices. And, whenever the platform invests, it's going to issue some shares to finance that investment. And, what you can show is that the problem of choosing investment and fees to maximize the share price is actually the same as choosing these two policies to maximize the present value of profits minus the costs of investment in the future. All right. So we can prove, quickly 2 propositions about equilibrium governance with a traditional platform, which are, not going to be very surprising. So, since this platform has some market power, it's going to charge equilibrium fees that are too high. All right, so this is going to lead to participation on the platform that's too low from a social perspective. And in particular, the cutoff 5-star that emerges in equilibrium with a traditional platform is equal to the first best minus a distortion that's going to come from the fact that investors fail to internalize 2 sources of user surplus. All right, so the first source of user surplus that isn't internalized is that all users get some convenience yields from holding transaction assets that let them transact on the platform. And then the second source of surplus that's neglected by investors is that investors are going to neglect the fact that inframarginal users get some rents because their cost of participating on the platform is going to be less than the marginal user's cost. All right. And because there is under-participation from a social perspective, there's also going to be under-investment in upgrading the platform in the long run. So basically, investment in the long run is set so that the marginal benefit of investing in an additional unit, which is equal to U prime of A, the increase in user utility divided by R, so discounted, times the number of users is equal to 1. But the number of users is too low, so the long run level of A is going to be correspondingly too low as well. So how can we understand at least why there's sort of under participation in the platform using that graph I showed you before? So basically, the part of total surplus that's internalized by investors is just profits. It's F minus C, the profit per transaction, times the number of users. So investors would like to set fees in order to maximize the size of this square here. But they don't internalize users' convenience yields that they get from holding transaction assets and transacting on the platform, or inframarginal rents. So the level of participation that maximizes the size of this square is generally not going to be the one that maximizes the size of this trapezoid. All right, and there's going to be some deadweight losses. All right, so now I'm going to show you basically how a centralized platform that issues tokens is going to be able to sort of partially resolve this issue at least when there's an ability to commit to a sequence of policies. All right, so in this case, the setup is going to be ultra little. So we still, the cash flow asset is still going to be shares that are held by investors and give them voting rights. But now the platform is going to issue some tokens that are going to permit users to transact. All right, now the price and quantity of these tokens is going to be endogenous. And so what's going to happen is at time 0, the platform is going to sell its initial stock of tokens to investors, to users, and the proceeds from that sale are going to be paid out as dividends to investors. And this is why investors have an incentive to commit to a sequence of policies that raises the initial price of tokens. All right, and then after time 0, the platform can finance future investments either by issuing additional shares or by issuing additional tokens. We don't put any restrictions on that. Now, in terms of governance, at each instant, investors are going to choose the level of investment and fees, but they'll also choose, the fraction of the investment to finance with tokens and the fraction of finance with shares. And, in this presentation, I'm just going to show you the governance problem with commitment, and then, from there, it'll be kind of simple to understand why the logic breaks down when there's no commitment. All right. So, in order to understand why having tokens can lead to potentially superior outcomes, it's worthwhile to understand how tokens are priced, right? So what you can show is that in equilibrium, the price of tokens is going to reflect the present value of convenience yield, which is basically the utility that you get at the margin for holding the additional token, times the number of users minus the future token finance, the cost of future investments that are financed by token issuance. All right. And on the other hand, the price of shares is equal to the present value of profits minus the future investments that are going to be financed by issuing additional shares. All right. So, when investors have commitment, what they do is they choose an entire sequence of policies to maximize the value of their endowment at time zero, which is equal to the entire stock of shares plus the initial stock of tokens that they're going to sell to users. So they want to maximize the present value of the sum of these two things. So they want to maximize the present value of the aggregate convenience yields plus profits minus future investments. All right. So, remember, in the case with the traditional platform, investors wanted to maximize this. And now, when they issue tokens, they want to maximize the sum of these two things, since the present value convenience yield is the value of the tokens that they sell at time zero. So this will incentivize them to set lower fees and increase participations. That's going to increase the size of this surplus that they internalize. All right, and because there's going to be higher participation equilibrium, there's going to be higher investment when the platform sells tokens and has the ability to commit. All right. So just to summarize, what I've shown is that the presence of tokens is going to partially align investors' policy preferences with users. And this is because investors internalize these convenience yields that users get from holding tokens, which reflects their value of transacting on the platform in the future. All right, but of course, this relies on commitment because you're promising future policies in order to sell tokens at a higher price ex ante. And without commitment, of course, this doesn't work at all. And after selling tokens at time zero, investors just want to maximize profits after that. And now the other thing to take note of here is that the ability to finance investments with tokens here is actually non-neutral. So, tokens are roughly speaking a claim on future user surplus. It's not just a retranching of the platform's cash flows. So Modigliani-Miller doesn't apply here. So tokens are going to expand the set of profitable investment opportunities because you can make investments that benefit users at the expense of investors in the future. All right. And the main question that we need to kind of ask here is how do we overcome this commitment problem that arises when the platform issues tokens? And yeah, what you can show is that actually, if in this sort of decentralized model of governance, you can partially get over the commitment problem. So what does the setup look like? Okay, so in this setting, instead of having two separate assets, there's just going to be one asset called a token with price Q. All right, and this is going to be held by both users and investors. So users hold tokens for transactions, and still their transaction quantity is equal to their real balance of tokens. And investors can hold the token and stake it to receive a claim on the platform's dividends. In particular, the dividend paid to each token is equal to the platform's total profits divided by the number of staked tokens, where zeta t denotes the fraction of tokens that have been staked. And in governance decisions, all agents are going to get to vote. All right, and whenever the platform has to invest, it issues some additional tokens. And votes on policies are going to be taken sequentially without commitment in this setting. And investors are going to get their most preferred policy if they hold a majority of tokens, and users will get their most preferred policy otherwise. All right. Okay. So how's this going to work? Well, just as in the previous case, the valuation that users attach to tokens is going to be the present value of tokens' convenience yields. All right. And on the other hand, the valuation that investors attach to tokens is going to be the present value of cash flows. So in equilibrium, the present value convenience yields is going to have to be equal to the present value of dividends, right? So what adjusts in equilibrium to make these two things equal to one another? It's going to be the fraction of staked tokens. So basically, off equilibrium, if users' token valuation is below that of investors, users will sell some tokens, which will increase the number of tokens that investors are staking and reduce the per token dividend. All right. And so, but the key result you should take away from this is that the price of tokens in equilibrium has to be equal to the present value of convenience yields plus profits. Just like in the case of a platform that issues tokens with commitment. The initial value of tokens plus shares was the present value of convenience yields plus profits. All right, so from here it should be obvious why you recover the commitment outcome in this decentralized setting, right? Because even if investors control the platform, they would like to set policies that maximize the present value of convenience yields plus profits, so you get exactly the same result as you did in the previous case. All right. So, and what's the intuition behind why having a single token resolves the commitment problem? It's because both constituencies want a high token price. So a policy that destroys too much surplus is going to reduce the token price, and that's going to even investors wouldn't want to pass a policy that gives higher fees if that's going to reduce token prices. Okay, so let me just wrap up. So I think you should take 3 things from this. So traditional platforms have this problem that their market power allows them to extract rents from users, which creates deadweight losses and possibly underinvestment. We shows that with commitment, token issuance can align shareholders' policy preferences with those of users. And now, on top of that, if you're missing some commitment mechanism, then this decentralized governance system can overcome the commitment problem, and you achieve the commitment outcome even without commitment. All right, because both constituencies hold the same token and want to keep its price high. All right, that's it. Thank you.
Thank you very much, Joseph. Take a question in the back.
Thank you for that. Investors and users, you both want the token price to go up. Mm-hmm. Now, can you reconcile that with the need for consumers of services to have stable cost structures? So if the token goes up so much, there has to be a mechanism that should regulate how it is that the users are able to consume at a reasonable price that's predictable in some way.
Right. So, in reality, I don't have much to say about that. In this model, remember the quantity of transactions I consume is equal to the real value of my token holdings, right? So no matter what the token price is, in order to transact 1 unit, I need $1 of tokens, not 1 token. But yeah, no, I agree. It could be an issue if you're thinking about like a token that you can redeem for a particular good and its price explodes, right? Like then, the good might become unaffordable. So yeah, that would be interesting to think about.
Do you think there's something interesting to say in the case when investors are risk averse? Because I think risk aversion is a sort of big component of it, that investors are not necessarily willing to hold tokens as if they were completely risk neutral.
Yes, let me think. I guess the first thing that comes to mind is there would sort of be, like there would be a risk premium on tokens, right? Which would lead to maybe less investment or something. What I'm not so sure about is how that interacts with the mechanisms that I've outlined here, right? So it's not clear to me whether risk aversion on the part of investors creates bigger problems if you have a traditional platform versus one that issues tokens versus a decentralized platform. No.
One last one over here.
Hi, I might have missed this part, but investment, do you mean issuing tokens in exchange for fiat? I might have missed that part.
Yeah, so investment is issuing tokens in order to raise some capital and then investing that in some real project. Like I don't know, I pay some developers to improve my system of smart contracts, or I expand the set of services that I offer or something like that.
Okay, the only reason I ask is typically they'll just issue the tokens instead of collecting let's say dollars in exchange for tokens. So I didn't know if that was something you looked into, how it applies to, let's say, DAOs that just pay people in their native token. And the other question was, what determines people's utility for transaction services, or the amount they're willing to hold at any point in time for transactions?
Okay, I see what you mean. So you're saying, like, for example, like yield farming, right? I just issue tokens as like an incentive to use the platform, right? Okay, yeah. So I guess that's not exactly, yeah, that's not really isomorphic to the investment I have here. I guess that's another type of investment you can think about where I'm basically, I'm paying a cost as a platform in order to attract users to the platform and, enhance network effects or something. Yeah, and then in terms of like from what do users derive benefits for transacting on the platform? I mean, what I have here is really just like a model where people, they're on this platform for some reason, it does something, allows you to rent out, computational services. I run into somebody, I can pay them to use their computer. But of course, that's kind of a deep question, right? There's always this question of like, what gives money value?